So I think there's been an anticipatory move that there is an appetite. So that's one reason the price has been quite firm here. And so I will say when a spot Bitcoin ETF is approved, because I think the probability is, well, we think it's 95% now, if not higher. But all the signals are, it could still, there could be still some details which, which would force the SEC, our ARC21 shares deadline, January 10th, is the forcing function here. And is there a scenario where the SEC would come to all of us in line and say, okay, we've just discovered this, we didn't know about it, we'd like to push all these decisions back up to them? I don't know, but so far, so good.
In today's video, we'll explore an interesting insight shared by Cathie Wood regarding the potential approval of a spot Bitcoin ETF. Cathie Wood expresses strong confidence, estimating a 95% chance, or possibly even higher, that such an ETF will be approved. This anticipation has contributed to the stability in Bitcoin's price recently, suggesting investors are optimistic about the approval. Wood mentions a specific deadline, January 10th, set by ARK Invest 21 shares as a critical date that could push the SEC, Securities and Exchange Commission, to make a decision. While there's always a possibility of unforeseen issues that could lead the SEC to delay its decision, so far, things look promising. In essence, we're diving into the anticipation surrounding the Bitcoin ETF, why it's significant, and how it's influencing market confidence, all while keeping an eye on the regulatory landscape and potential hurdles.
I think a couple of things happened, especially something 5 years ago in 2018. Cambridge Associates, which is a consultant to institutions, endowments, foundations, and so forth, wrote a paper about Bitcoin and said to the institutional world, okay, you may agree with all of these leaders who are calling it a Ponzi scheme or an environmental scourge on the system, but recognize that the correlation of risk and return between Bitcoin and all of these other assets is very low. So what we probably have here is a new asset class. And what institutions do know is that the best way to increase returns per unit of risk is to diversify into a new asset class. So this is very important. And so Cambridge back then said, you may not like it, and you may really believe all these people who are saying these horrible things about it, but this is the way it's behaving. And our study, and we've put this study out, we're updating it now, on what should be the institutional allocation in a broad-based portfolio to Bitcoin. If you want to, this is as of last year, we're about to publish new numbers, but as of last year, if you wanted to minimize volatility, the optimal weight of Bitcoin in your overall portfolio would be 2%. If you want to maximize your Sharpe ratio, so your return per unit of risk, then the number is closer to 6%. And this kind of makes sense because I remember other new asset classes, real estate, very early in my career. So 70s and 80s, real estate was the new asset class. And institutions started with a 1% allocation and then gradually moved up to that 5-ish%, maybe above. And then emerging markets, when that became a category, because it wasn't one emerging market at a time, but it was a category, a new category. Again, started with 1 and moved up to 5%. That, we believe, is what is going to happen here. And I think the fact that we and others are educating institutions that, wait a minute, this is mathematically metered to go up to 21 million units, and we're at roughly 19.5 million. The scarcity value is already showing itself. And with institutions starting to push in, that will be ever more true. So might we get a sell on the news? Well, sure, we've had a nice little burst here, and there's just the hedge funds trade on anything, on any news. So you could have a bit of a sell-off, but we think that the institutional demand is going to take this new asset class much higher in terms of market value.
Cathie?
In a captivating insight, Cathie Wood highlights how back in 2018, Cambridge Associates made a groundbreaking assertion to the big players in finance. Despite the skepticism surrounding Bitcoin, labeling it as anything from a Ponzi scheme to an environmental menace. They pointed out that Bitcoin's risk and return profile hardly aligns with traditional assets, suggesting it's emerging as a brand new asset class. This is a big deal because diversifying into new asset classes is a known strategy among institutions to enhance returns without significantly upping the risk. Cambridge Associates even recommended specific Bitcoin allocations for investment portfolios, aiming for stability. A modest 2% might be your best bet. Chasing the best return per unit of risk. Consider nudging that figure up to 6%. This advice mirrors the historical embrace of other asset classes like real estate and emerging markets, which started small but grew to become staples in institutional portfolios. Wood is optimistic about Bitcoin's future, especially as it nears its maximum supply of 21 billion coins, underlining its scarcity and potential value increase. Despite the possibility of short-term sell-offs, perhaps prompted by news events, a common hedge fund strategy, she believes institutional interest in Bitcoin will only soar, significantly boosting its market value. This, in essence, is a testament to Bitcoin's growing acceptance and potential as a mainstream investment asset.
The base layer hacks have been de minimis, Philia, correct me. It's the layer ones. It's it's not the base layer, it's the layers on top that have been hacked effectively. And once they understand that, they have to step back and reassess it because, base layer Bitcoin is where they will have the exposure, right? In cold storage. It depends on which issuer, but in our case, at Coinbase.
So what is it about an ETF that suddenly switches on to like institutional allocators to be like, oh, I've been waiting for this product. I've been waiting for like 13 years for this product. That's a piece that doesn't, I think, make sense to a lot of people who are in crypto, because if these institutions are bullish, why would they wait until after an ETF to buy? They should have bought, months ago. Like, what is it with the ETF structure that just makes it more conducive to institutional flows?
They have to have been looking at this. I mean, we've certainly been putting the research out, but they needed the regulatory seal of approval, and that will be the SEC approval of a spot Bitcoin ETF, because if it's good enough for the retail investor, again, the SEC is really thinking about the retail investor. If it's safe enough for them, then institutions certainly should not dismiss it as a new asset class. I think the seal of approval from the SEC, especially given how vociferously the SEC has said, I think, has made incorrect observations. We know the people in the research department at the SEC, the crypto research department, they are very good. They know what they're talking about. And I think some of what we've witnessed out there has been much more political in nature than grounded in fact, but it has confused and obfuscated. And institutions do not want to get in the way of that kind of dogfight, right? Now they've got the judicial system on their side. Okay, check. Legislative side is starting to move in the right direction. So these are all sources of confidence, I think, for the institutional investor, which is a very conservative investor. We have grown up in a world and that has gone very benchmark sensitive. They don't want to put anything in their portfolios that isn't in a benchmark. I founded ARK for that reason, because there are so many exciting companies and opportunities out there that aren't in benchmarks, and certainly Bitcoin isn't. This, again, is one of the reasons I founded ARK, but we needed the checks of the checks and balances for institutions to really say, okay, it's safe now.
In this insightful discussion, Cathie Wood clarifies a common misconception about Bitcoin's security. She points out that the main Bitcoin network, or the base layer, has remained remarkably secure, with most security breaches occurring in the additional layers built on top of it, not the foundational Bitcoin layer itself. This is an important distinction for institutional investors, who, when considering investment, prioritize the security of their assets, often stored in cold storage, like with Coinbase, for example. Wood then delves into the intriguing question of why institutional investors seem to be waiting for a Bitcoin ETF before making substantial moves into the cryptocurrency space. Despite being bullish on Bitcoin, these investors appear to be holding back until an ETF is approved. The reason? Regulatory approval. Institutional investors are looking for a seal of approval from regulatory bodies like the SEC. Approval of a spot Bitcoin ETF by the SEC would signal to these investors that Bitcoin is a safe and legitimate asset class, removing a significant barrier to entry. She criticizes the SEC for its previous stance and comments on Bitcoin, suggesting that political motives, rather than factual analysis, have clouded the SEC's judgment. However, with the judicial system beginning to show more support and legislative bodies moving in a positive direction regarding cryptocurrency, institutional confidence is growing. Wood emphasizes the conservative nature of institutional investors, who prefer to invest in assets included in major benchmarks. This caution is part of why she founded ARK Invest, to capture opportunities like Bitcoin that are outside traditional benchmarks but offer significant growth potential. The development of a Bitcoin ETF, coupled with a regulatory environment that's gradually becoming more supportive, is seen as a crucial step towards making Bitcoin a staple in institutional investment portfolios, ensuring it's viewed as safe and reputable.